Since the pandemic, millions rushed to Florida chasing sunshine, low taxes, and affordable living. But drive through the state today, the picture is unrecognizable. Subdivisions sit half-built, streets echo with silence, retirees pack up. Inventory is up 60% year over year. Days on market have tripled. Insurance premiums top $10,000 annually. The Florida dream has become a financial death trap. It's free fall turning paradise into a pressure cooker, where growth fuels collapse. Tonight, we reveal the 10 cities falling fastest. Epicenters where equity vanishes and communities hollow out in real time. Stay until the end because the #1 city isn't just Florida's tragedy. It's America's warning. Let's begin with Panama City. 6 years after Hurricane Michael, Panama City sold itself as a phoenix rising from disaster, rebuilt, resilient, and ready for new residents. The promise seemed real: rebuilt infrastructure, coastal beauty, and affordable waterfront living. But beneath the surface, rebuilding dreams have crumbled into financial catastrophe. The numbers tell the brutal story. Condo values have cratered 6 to 10% year over year, while listings linger for months. Yet the real devastation comes from insurance premiums that now hit $12,000 to $15,000 annually for coastal properties. For families who rebuilt after the storm, these costs have transformed recovery into a second disaster, more brutal than the hurricane itself. And then there's the tourism mirage. The economy that was supposed to fuel Panama City's comeback has proven tragically fragile. Spring break crowds and summer visitors create brief illusions of prosperity, but seasonal demand cannot sustain year-round property values inflated by pandemic speculation. When tourists leave, only mounting bills remain. The employment collapse amplifies the crisis throughout the region. Construction jobs that surged during rebuilding have vanished completely, taking with them the paychecks that supported local spending. Equipment suppliers, material vendors, and subcontractors who expanded to serve the rebuilding boom now operate with skeleton crews, while warehouses echo with emptiness. For retirees, the trap has snapped shut with devastating finality. Those who moved here chasing affordable coastal living find fixed incomes helpless against insurance spikes that rival mortgage payments. Many are quietly packing up, abandoning communities they thought would provide security. Yet the properties they're fleeing often can't be sold at reasonable prices. While bargain hunters circle distressed properties, the fundamental problems remain. Insurance costs that rival mortgages, infrastructure overwhelmed by speculative growth, and a community hemorrhaging residents. Panama City's recovery has devolved into boom and bust cycles, leaving families trapped between unaffordable carrying costs and properties they cannot escape. Once positioned as Orlando's perfect escape valve, Deltona promised suburban tranquility without urban price tags. The planned community concept seemed foolproof. Master-planned neighborhoods, family amenities, and commuter-friendly access to major employment centers. But Deltona has become a stark monument to what happens when development races ahead of demand. The price drops tell only part of the story. Home values have slipped 5 to 7% year over year, creating underwater mortgages for recent buyers. But the real devastation unfolds in entire streets lined with for sale signs that have become permanent fixtures. Spec builders who raced to capitalize on pandemic demand now face subdivisions where completed homes sit empty month after month, burning cash through carrying costs that mount relentlessly. And then there's the economic cascade. The construction slowdown has triggered devastation throughout the local economy. Equipment suppliers who expanded operations to serve Deltona's growth now warehouse idle machinery representing millions in stranded capital. Subcontractors who relocated for steady work find themselves driving hours to find projects paying a fraction of boom time rates. Material vendors face shrinking order volumes, while inventory costs consume margins. For families, the American dream has become a nightmare. Those who moved here seeking affordability face a cruel paradox defining modern housing markets. Buyers at peak prices watch equity evaporate daily, while homeownership has become a lottery where timing determines financial survival. Those who got timing wrong face decades of underwater payments. But the municipal crisis runs deeper than individual hardship. Local finances strain under infrastructure built for growth that has vanished. Roads, utilities, and schools constructed for projected populations must be maintained even as property tax revenues moderate drastically. Budget pressures force cuts that degrade quality of life, creating a vicious cycle of decline. The current correction exposes harsh reality planners ignored. Infrastructure debt from rapid development remains, while the community struggles to maintain services for a population that may never materialize. Strategically positioned between Tampa and Orlando, Lakeland built its identity around logistics supremacy. Amazon, FedEx, and distribution giants operate massive facilities throughout the region, creating thousands of jobs and what appeared to be limitless housing demand. But even logistics powerhouses cannot overcome fundamental economic mathematics that spell disaster for workers. At the heart lies an impossible equation defining modern housing failure. The core problem is a devastating wage-housing mismatch creating financial impossibility for workers who power the economy. Warehouse and distribution workers typically earn $35,000 to $50,000 annually, but median home prices remain catastrophically above what these incomes support, even after recent 5 to 7% corrections. This gap creates recruitment nightmares for employers while delivering financial devastation for workers forced into crushing commutes or unaffordable debt. And the inventory explosion tells the real story of market collapse. Homes now languish 60 to 80 days compared to 30 to 45 days during peak demand, while desperate sellers slash prices repeatedly. New subdivisions built during pandemic speculation feature substantial numbers of unsold homes, their fading model home signs serving as tombstones for dead dreams. Meanwhile, builders slash construction schedules as reality intrudes on optimistic projections. The rental market amplifies devastation across all price points. Properties purchased for short-term rental income struggle as tourism patterns normalize and competition intensifies beyond sustainability. Investor owners switching to long-term rentals or selling outright add relentless pressure to an already oversupplied market gasping for buyers. Each additional listing pushes prices lower in a cascading effect. But employment collapse spreads pain far beyond construction. Jobs that once drove local prosperity have contracted sharply as building activity collapses entirely. Hardware stores that expanded for boom-time demand now face empty aisles and reduced hours as contractors disappear. The economic multiplier effect that drove prosperity now works in brutal reverse, amplifying every decline throughout the community. While Lakeland's logistics infrastructure provides stability, it cannot overcome the fundamental disconnect between wages and housing costs that makes the region unlivable for its workforce. The economic foundation that attracted growth has become its greatest weakness, creating a permanent affordability crisis that transforms opportunity into exploitation. Lakeland remains trapped between economic potential and housing market reality that serves investors rather than workers. Blocks of purpose-built vacation homes now sit dark on weeknights, their empty windows reflecting the collapse of Kissimmee's speculative dreams. The city's proximity to Disney World seemed to guarantee eternal demand, making it a magnet for vacation rental investors and tourism-dependent businesses. But the Magic Kingdom's shadow has revealed darkness beneath communities built on speculation rather than sustainable economics. Price softening masks deeper devastation lurking beneath surface statistics. Home values have declined 4 to 6% over the past year, with vacation rental properties suffering steepest losses as reality intrudes. But the real story unfolds in the investment bloodbath destroying individual fortunes daily. Airbnb purchases made during pandemic hysteria now generate negative cash flow as occupancy rates collapse and operating costs climb relentlessly. And rental market destruction spreads like wildfire through investor portfolios. The short-term rental sector confronts a perfect storm of annihilation, leaving no survivors. Oversupply from desperate investor owners, exploding insurance and maintenance costs, stricter local regulations, and fundamentally changed travel patterns have obliterated both occupancy rates and pricing power. Properties that once commanded premium rates now compete desperately for any bookings at all, often at rates below break-even costs. But the conversion crisis runs deeper than simple market correction. The shift from vacation rentals to traditional housing offers no salvation for communities designed around transients. These properties were designed for transient visitors, not permanent communities, creating neighborhoods without soul or stability, where residents never develop roots. Kissimmee's challenge extends beyond housing costs to rebuilding economic identity beyond the wreckage of speculative tourism investments. The Magic Kingdom's shadow has exposed fundamental fragility of communities built on dreams rather than sustainable economic foundations. When those dreams shatter, they leave behind debris that takes decades to clear. Kissimmee stands as proof that proximity to fantasy cannot sustain reality when financial gravity reasserts itself. Port Charlotte once marketed itself as the perfect retirement destination, promising affordable living, warm weather, and communities designed for seniors. But rising costs have transformed this promise into cruel deception that devastates retirees on fixed incomes. And demographic exodus accelerates with devastating momentum throughout the community. Insurance costs have roughly doubled in 5 years, reaching $6,000 to $8,000 on modest homes, while prices still slipped 3 to 5% year over year. The collapse becomes visible in empty driveways and darkened windows. Younger working-age families avoid Port Charlotte entirely, given impossible price-to-income ratios making homeownership fantasy. Meanwhile, established retirees quietly pack up and flee, their retirement dreams shattered by financial reality. Some retreat to family homes in other states, while others relocate to less expensive inland communities where insurance costs haven't exploded dramatically. The healthcare crisis follows demographic decline with predictable brutality. Facilities and senior services report alarming changes in demand patterns as their target demographic becomes increasingly price-sensitive. Assisted living facilities note rising vacancy rates as potential residents choose to remain in previous communities rather than relocate to increasingly unaffordable Florida markets. The spiral continues as reduced demand forces service cuts that make the area less attractive to remaining seniors. But business collapse spreads throughout the community like economic cancer. Local businesses built around growing senior populations face devastating demand reductions, threatening survival. Restaurants that expanded dining rooms for new residents now operate with empty tables and reduced staff. Retail establishments focused on retirees see collapsing sales as their customer base becomes budget-conscious or disappears entirely. The housing market reflects these demographic pressures through extended selling times and frequent price reductions, signaling deeper problems. Properties that were supposed to provide retirement security have become financial burdens, forcing impossible decisions about where to spend remaining years. Those decisions increasingly involve leaving Port Charlotte behind for more affordable alternatives. While lower-cost alternatives exist inland, they lack amenities and healthcare infrastructure that attracted retirees originally. Port Charlotte's promise of affordable retirement has completely collapsed, leaving a community designed for a demographic that can no longer afford to live there. The retirement exodus accelerates as fixed incomes prove helpless against Florida's brutal new financial reality. Naples marketed itself as Florida's answer to the Hamptons, exclusive, sophisticated, and seemingly immune to broader market forces affecting lesser communities. But even luxury markets discover gravity when financial reality reasserts dominance over speculation and status. And insurance shock hits differently in luxury markets, where costs become embarrassingly visible. High-end sales have plummeted 25 to 35% from peak levels, while $2 to $5 million listings linger for months, like unwanted artifacts of excess. Coastal mansions that once carried $15,000 to $20,000 annual premiums now often exceed $25,000 to $35,000 for basic coverage. For ultra-wealthy buyers, the issue transcends affordability to strike at value perception and social status. The cost-benefit equation no longer supports premium pricing for what amounts to expensive vulnerability, making ownership feel foolish rather than prestigious. Construction slowdown signals broader trouble in luxury development pipelines. Projects continue at drastically reduced pace, with developers reporting extended sales periods and intensive negotiation on upgrades and finishes that were once automatic. Some projects have fundamentally adjusted pricing strategies to reflect current demand realities rather than peak pandemic enthusiasm that drove earlier speculation to unsustainable heights. But service economy collapse amplifies pain throughout Naples' luxury ecosystem. Economic devastation ripples through businesses depending on affluent seasonal residents for survival. High-end restaurants, galleries, and luxury retailers report sharply reduced activity as their customer base contracts dramatically. Employment in hospitality and personal services faces mounting pressure as the wealthy visitor population supporting these jobs simply disappears. Local realtors describe the situation as normalization rather than collapse. But normalization in a luxury market feels catastrophic when properties lose hundreds of thousands in value within months. After years of extraordinary appreciation that seemed permanent, Naples discovers what happens when speculation collides with financial gravity that recognizes no exception for wealth. Naples retains infrastructure and amenities defining luxury living. But the fundamental value proposition has shifted, permanently beyond recognition. Annual carrying costs now rival purchase prices that once defined entry-level luxury markets, representing recognition that Florida's luxury coastal living has been repriced beyond most buyers' comfort levels, regardless of wealth. Rebuild math no longer works in Fort Myers, where financial reality has crushed recovery dreams. Insurance has jumped to $7,000 to $10,000 annually. Days on market stretch to 70 to 80 days, and investor flips stall completely, even with only a 2 to 4% headline price drop masking deeper devastation. Fort Myers tells the story of natural disaster recovery colliding with broader market forces, creating a perfect storm, leaving families choosing between rebuilding and financial survival. And investment carnage spreads through portfolios like financial wildfire. Hurricane Ian's 2022 impact initially attracted investors hoping to buy the dip in classic disaster capitalism fashion. But those bets now look catastrophically premature as reality intrudes on opportunistic optimism. Properties purchased for renovation and resale take months longer to sell than projected, while profit margins evaporate under exploding insurance and construction costs, devouring investment capital with ruthless efficiency. Construction picture confirms collapse accelerating across all sectors. Activity provides visible evidence of market devastation that cannot be hidden by statistics. While hurricane rebuilding continues out of necessity, new speculative development has slowed dramatically as builders flee the market. Construction crews that once filled local hotels have relocated to other markets with better prospects, leaving behind unfinished projects and unpaid bills scarring the landscape. But local government faces fiscal reckoning, amplifying every other problem. Financial pressures mount as tax revenues that swelled during the boom moderate, just as infrastructure needs from storm recovery remain enormous and urgent. City planners adjust growth projections downward, while reconsidering expansion projects that no longer seem financially viable. The intersection of climate risk and financial reality now defines Fort Myers' future entirely, creating impossible choices for residents. Families face decisions between rebuilding costs they cannot afford and properties they cannot sell at reasonable prices. The community that symbolized resilience after Hurricane Ian now represents unsustainable economics of coastal living in an era of escalating climate and insurance costs. Ocala's cherished identity as the horse capital of the world faces existential threat as housing market pressures collide violently with agricultural land use, forcing a community to choose between preserving heritage and ensuring economic survival. Values have dropped 6 to 8% year over year, with rural and acreage properties suffering steepest losses in a market that traditionally provided stability. Horse farms and large acreage properties that commanded premium prices during pandemic speculation now take months to sell while accepting substantially lower offers, threatening viability. The equine industry, already under severe pressure from global competition, faces systematic dismantling as real estate speculation destroys the economic foundation supporting horse operations that defined the region for generations. And the industry faces systematic destruction from multiple directions simultaneously. Challenges extend far beyond housing costs into fundamental economics of horse farming. Exploding insurance premiums, increased property taxes as agricultural exemptions face scrutiny, and relentless competition from residential developers systematically destroy economic structures that supported horse operations for decades. Tax policy changes accelerate decline with bureaucratic efficiency. Changes create particularly devastating pressure as counties desperately seek revenue from residential development. Agricultural exemptions face strict enforcement or complete elimination, increasing operating cost for horse farms while property values decline, creating financial stress from multiple directions simultaneously, making survival impossible. But employment contraction spreads pain far beyond agriculture into the broader community. Construction jobs that surged during pandemic building have contracted sharply as residential projects collapse entirely. Workers who relocated to Ocala for high-paying construction jobs find fewer opportunities, forcing departures that further reduce demand for housing and services in a vicious cycle of decline. Demographic shifts affect community services measurably as the economic base erodes. Schools built for growing populations see enrollment decline as families leave for opportunities elsewhere. Meanwhile, retail businesses that expanded to serve new residents adjust to drastically reduced demand, threatening survival. Current market conditions expose the impossible choice between preserving agricultural heritage and achieving economic survival in modern Florida. The horse capital of the world identity requires land prices and tax structures that residential development has permanently destroyed. Ocala's transformation reflects the broader challenge facing rural communities where traditional industries cannot compete with speculative real estate pressures. Sebastian's small-town charm on the Treasure Coast attracted significant attention during pandemic speculation, but its intimate size makes every aspect of current market correction painfully visible to residents who cannot escape the reality. With just 25,000 residents, every foreclosure, price reduction, and empty property becomes a community landmark, broadcasting failure and financial devastation affecting everyone. Home values have plummeted 8 to 12% over the past year, representing some of Florida's steepest corrections in a market with few places to hide. Properties that sold within days during pandemic demand now spend 80 to 100 plus days on market, with price reductions becoming standard rather than exceptional as desperation spreads through seller ranks. And insurance devastation is particularly cruel in a community where modest incomes meet premium costs. Coastal insurance costs devastate Sebastian's middle-class community with crushing efficiency, leaving no escape. Annual premiums of $8,000 to $12,000 are typical for waterfront properties, with some homeowners reporting even higher costs consuming discretionary income entirely. For a community where median incomes remain relatively modest, these expenses create genuine financial hardship, forcing impossible choices between shelter and survival. The small-town amplification effect is brutal and inescapable for residents. The town's intimate size amplifies every market change into community trauma affecting social fabric. When homes enter foreclosure or sit empty for extended periods, the impact on neighborhood appearance and community morale becomes immediate and unavoidable. On some blocks, 3 for sale signs share the same view of the river, creating permanent fixtures mocking dreams of families who bought into coastal lifestyle. But business collapse follows inevitably as the customer base erodes. Local businesses that expanded during the boom now confront harsh reality of reduced demand threatening survival. Restaurants that hired additional staff for new residents cut hours and reduce menus, while empty tables mock previous optimism. Retail businesses see collapsing sales volumes as residents become budget-conscious or simply leave the area entirely. Tourism, traditionally important to Sebastian's economy, has faced severe pressures compounding the residential crisis. Rising accommodation costs and increased competition from other coastal areas have devastated visitor numbers, impacting businesses depending on seasonal spending to survive slower periods when residents alone cannot sustain them. Sebastian's small size amplifies collapse, while offering no economic diversification to cushion devastating impact. Beach towns cannot survive on seasonal tourism alone when carrying costs have increased year-round, exposing fundamental vulnerability. A community too small to weather economic storms and too expensive for its core demographic to afford. Cape Coral once marketed itself as a waterfront paradise with more canals than Venice, promising affordable luxury living in a boating enthusiast's dream location, where middle-class families could afford waterfront access. Instead, it has become the absolute epicenter of Florida's housing market collapse, a community where water access has transformed from asset into devastating financial liability, destroying rather than enhancing wealth. The numbers paint complete devastation that cannot be disguised by optimistic marketing. Median home prices have crashed 8 to 10% over the past year, with waterfront properties suffering even steeper declines, wiping out equity built over decades. Supply has exploded past 6 months in many neighborhoods, catastrophically above the 3 to 4 months signaling market balance. Homes now languish for nearly 90 days compared to 30 days when buyers competed for limited inventory in a seller's market that seems like ancient history. Properties that once attracted multiple offers now sit with repeated price reductions, signaling desperation spreading through seller ranks. Some drop $20,000 to $40,000 from initial asking prices, as sellers grow desperate to escape mounting carrying costs, consuming savings monthly without end in sight. But insurance catastrophe defines the crisis, making waterfront living financially impossible for most buyers. The true devastation lies in premiums that have transformed waterfront living from affordable luxury into financial catastrophe. Canalfront homes routinely face annual insurance bills exceeding $8,000, with high-risk properties reporting costs above $12,000, rivaling mortgage payments. For retirees on fixed incomes who moved here seeking affordable paradise, these expenses have transformed dreams into monthly budget nightmares, forcing impossible choices. And construction distress is visible everywhere throughout the community like scars on the landscape. Projects throughout Cape Coral display signs of complete economic breakdown. Entire subdivisions showcase "for sale" signs on streets that were supposed to be fully occupied, according to original marketing promises. Some developments show signs of delay or suspension, as builders reassess demand projections that proved wildly optimistic and financially ruinous. Business devastation spreads throughout Cape Coral's service economy like economic cancer. Economic collapse extends through every sector that depended on growth. Furniture stores that expanded to serve new arrivals scale back operations and reduce staff as customers disappear. Restaurants report slower weekday traffic as construction crews vanish from the area entirely. The community that once buzzed with growth activity now moves with cautious uncertainty pervading every business interaction. Local businesses feel the shift in tangible ways affecting daily operations and survival prospects. Marine supply stores that stocked up for boating enthusiasts find inventory sitting unsold as boat owners flee the market. Real estate offices that hired additional agents during the boom now operate with skeleton crews while commissions evaporate. Economic multiplier effects that drove prosperity systematically reverse, amplifying every decline throughout the community. Cape Coral's waterfront identity has become its greatest liability, an ultimate destroyer of wealth rather than creator. The canal system that once symbolized luxury living now represents unaffordable risk that few buyers will accept voluntarily. Supply continues growing, while demand shrinks in a feedback loop of declining values and increasing financial stress feeding on itself relentlessly. Cape Coral's transformation from dream destination to financial nightmare illustrates complete collapse of Florida's speculative waterfront markets. A warning that water access in the age of climate risk and insurance reality has become a luxury few can afford and fewer still will risk. The American dream of waterfront living has become a waterfront nightmare, destroying rather than building wealth. The final reckoning. These 10 cities reveal the anatomy of Florida's housing market collapse. Communities destroyed by speculation meeting reality. When growth becomes unsustainable, the very advantages that attracted people transform into financial liabilities. The numbers tell a consistent story. Inventory rising, prices falling, homes taking longer to sell. Behind every statistic are real families. Retirees watching savings evaporate, workers priced out, investors learning markets collapse as quickly as they rise. Florida's crash previews broader national trends threatening coastal communities everywhere. Rising insurance costs, affordability pressures, and systematic repricing of coastal living are emerging across the country. The state that led pandemic housing growth now leads the painful adjustment back to reality. The key lesson cuts to the heart of sustainability. Markets thrive when they serve communities rather than speculators. Cities prosper when they balance growth with affordability, serving residents rather than investors. Recovery remains uncertain as fundamental economics have shifted permanently. Structural changes in insurance costs and climate risk suggest this represents permanent repricing rather than temporary adjustment. For America, Florida offers stark warning and instruction. The opportunity exists to build communities balancing growth with affordability, housing markets serving families rather than investors, and coastal development acknowledging climate reality. The sunshine still attracts residents. Beaches remain beautiful. Tax advantages persist. But Florida's housing market is learning that unsustainable speculation eventually destroys the communities it claims to develop. If this opened your eyes to America's housing crisis, subscribe for deep dives into cities where the next crisis is building. The housing reckoning is just beginning.